Buyer beware. Make sure your IUL is designed to make you the most money. In this educational episode, I'm going to address the questions: what is the downside of IUL? What can go wrong with an IUL? Get ready. I hope you will learn quite a bit from what I'm going to share with you. So I'm Doug Andrew, and I've been doing this. What's this? Helping people maximize their assets, optimize them, and minimize taxes and prepare for a comfortable retirement so they will not outlive their money. And I've been doing it for just about 5 decades. My favorite financial vehicle to accomplish these goals and to make retirees immune from the negative impact of taxes, inflation, and market volatility is a properly structured, max-funded, indexed universal life, IUL. And if it's structured properly and funded correctly, it is deemed what I call a laser fund. Laser is an acronym that I have used for years. It stands for Liquid Asset Safely Earning Returns. So let me share with you how you can tell if the advisor is proficient, or let's talk about what can go wrong. You know, many times when I teach educational events, I will hear people say, I've always thought that insurance in general was a poor investment. And then they're shocked when I say, actually, we agree. Why do we agree? Because it's not an investment. It's a tax-free vehicle. If you understand TEFRA, DEFRA, and TAMRA tax citations, if you keep it from being deemed an investment, which is taxed in a separate part of the code, then it cannot be called an investment. So it's not an investment. It's an insurance contract, and it adheres to tax laws so that you can accumulate, access, and transfer your money tax-free. But unfortunately, most insurance is not structured correctly and funded properly to accomplish the best results for living benefits. Most people have come to me in my career not wanting death benefit per se. That is one desire, but it seems to be secondary. Their primary purpose is they want a financial instrument where they can accumulate their money on a tax-favored basis and then be able to turn on tax-free income during retirement. And at the end of the day, when they die, then it blossoms and transfers income tax-free in the form of a death benefit. And the best way to do that is with a max-funded indexed universal life insurance contract. I'm going to gift you a copy of my most recent best-selling book that talks about this at the end of this episode, so stay with me. So what can go wrong? Well, let's briefly share. If it's not structured correctly under these tax citations, known as TEFRA and DEFRA, many agents put too much insurance on there. Therefore, it cannot perform as well because my goal is to have my clients earn an average rate of return, sort of like I have, by using diversification and various index accounts and by rebalancing on an annual basis at a minimum. And that's how you're able to tweak the rate of return. And I've averaged 11.17% on my index universal life since 1997. Now, retroactive back to day one, I have netted 10.07. So that means the actual cost of the insurance is only about 1 percentage point, and I'm netting 10% cash on cash. That means, you know, if I have $1 million accumulated at retirement, I can take out $100,000 a year without depleting principal at a 10% payout for as long as I live. And that's totally tax-free. You can't believe how many agents do not understand how to structure it properly. And so what I call the spigot on the bucket is bigger than it needs to be. And even if they did rebalance and diversify you, and you accomplished an 11% rate of return, you might only net 5, 6, or 7% because they put too much insurance on the contract. Unfortunately, a lot of agents don't know how to rebalance and diversify. And so the average return might only be 8 or 9%, which isn't bad. 8 or 9 is tax-free. But if you're going to earn 9, you want to net 8. You don't want to earn 9 and net 4, okay? And so that's number one. Number two, yeah, if it's not funded correctly. So if you design an insurance contract to accommodate, $20,000 a year, $500 a month, $100,000 a year, make sure that you do that. But if life changes and you have to adjust it, make sure you adjust it, or else it's not going to perform as originally illustrated, okay? If it's not designed in accordance with IRS guidelines to be tax-free. And so in order to be able to access money tax-free down the road, we want to adhere to TIFRA, DIFRA, and TAMRA tax citations. And this TAMRA is the Technical Miscellaneous Revenue Act of 1988. But also you want to make sure you can accumulate money tax-free under Section 72E of the Internal Revenue Code. But when you go to access money or turn on income later, you want it to be tax-free. You have to adhere to 7702 of the Internal Revenue Code. And at the end of the day, when you die, it will blossom, increase in value, and transfer tax-free under Section 101A. So if a policy is not designed in accordance with these guidelines, you're not going to have a good experience. You're going to miss out on some of the money that you could have made. If you use the wrong product. Now, there are probably 70 or 80 companies that offer indexed universal life. There's probably 200 or 300 products. I'm sort of picky. There's only, a dozen or so companies that I put my serious cash into, but basically most companies have pretty good design. Maybe you could average 2% higher rates of return with some companies or products. And so you want to use a good product, and I like the companies and products that whenever they update their products, they give the same benefits to the older policies that have been enforced, okay? So if you use the wrong product, it may not perform as well as it could. If you use the wrong company, because maybe what your goals are would be better suited with an indexed universal life that's offered by another carrier. Or maybe you're picky about the safety ratings of the companies, and we usually like to use companies that are rated in the top 10 percentile by looking at vital signs and so forth and all of their ratings. So the wrong product, the wrong company. But here's the biggie. If the advisor is not proficient, this has been the biggest reason, and in the 50 years I've been a financial strategist, it's the saddest day when people come to me and they say, Doug, I heard you, I attended one of your events, I heard what you said on the radio, I watched a video, and I said, okay, that's what I want. And I realized, well, golly, I've got a nephew with an insurance license. I've got a brother-in-law with an insurance license. They'll probably help me do this. That's usually a huge mistake. They'll come and they'll hear me on the radio and I'll say something like, well, if you had $500,000 in your IUL policy 7.5 years ago, it should now exceed $1 million. You should have doubled your money by now. Pretty slam dunk. That's 9.6. If you got a good advisor, they would have been tweaking it, rebalancing it. Maybe you would have doubled it within 5 or 6 years. And these people, they come to me and they say, I had $500,000 and I heard you on the radio. I don't have $1 million today. In fact, I don't even hardly have 500,000. It's going down. What's wrong? And I take about 30 seconds and look at it and I go, who set this up? And they go, our nephew, he had an insurance license. He said he could do it. Or my brother-in-law. And I said, wow, that was an expensive relationship. So let's talk about that one, because when you set up an IUL correctly, I call it the dream solution. It's like a financial Swiss Army knife. And yes, you want to set up this dream solution for all kinds of financial goals, and there's a death benefit there, which is, always nice. It gives you peace to know that if you happen to pass away, that whatever's in the account is going to generate, blossom and transfer income tax-free. It's one heck of a rate of return, but I don't recommend dying to get your money, okay? Most people use it for retirement planning because it knocks the socks off of IRAs and 401ks. But maybe you're setting up an IUL for the use of a college savings plan, because this is far better than a 529 college savings plan, which does not have near the flexibility. If you're a business owner, we have many business owners that set up IUL policies as working capital accounts, and they actually use the banking concept where they borrow using their cash value as collateral for their business, and they can borrow at 5%. and they keep earning 10, 15, 20, 25% or more on the money in their policy that's collateralizing the loan from the insurance company. It's incredible. Same thing with real estate management. If you're smart, you wouldn't be sending extra principal payments against the mortgage to get out of debt. You'd put it into an IUL that's earning 9%, compounding tax-free, and the net cost of a 4.5% deductible mortgage is only 3%. You're making 300%. You're making 3 times as much as the mortgage is costing you. You'll get out of debt 2.5 years faster. An emergency fund. This is where banks and credit unions put 30 to 40% of their tier 1 assets for liquidity and safety. So if you need an emergency fund in this day and age, you don't need some institution with a drive-up window down the street when you can access money, if needs be, with an electronic funds transfer or phone call. Just bypass the middleman, because this is where banks and credit unions put a lot of your money, in insurance companies. Lump sum, capital transfer. This is where you get settlements or you come into a lump sum. All kinds of capital that sometimes comes into our lap, windfalls. Estate planning, pension maximization. If you're a school teacher, a police officer, a firefighter, don't take the survivor benefits. Take the no survivor benefit and take the differential between the no survivor benefit, maybe $5,000 a month, and the survivor benefit, which is maybe $4,000 a month. Take that $1,000 a month and put it into an IUL. You'll be way better off than being forced into buying the most expensive life insurance policy you'll ever buy from the state where you retired as a school teacher. And also tax reduction, to do strategic rollouts out of IRAs or 401ks, get the taxes over and done with sooner than later, reposition it into an IUL, and have tax-free income forever after, and you're immune from the dangers of taxes, inflation, and market volatility. So this is why when we teach the merits of IUL, there's like 38 benefits. This is called a mind map. And so max funded tax advantage insurance, if it's structured correctly and funded properly, it is incredibly liquid. It passes the liquidity test, the safety test with flying colors, rate of return, because your average net rate of return can be 10% tax-free. You'd have to be earning 15 or 16% in a tax-deferred IRA or 401k to net 10 after paying taxes on an IRA. The death benefit. Legal advantages. Oh, my heavens, these are next to impossible to penetrate in courts of law in this so-happy society we have become. And then, of course, the tax benefits. You're able to accumulate, access, and transfer money totally tax-free. So in my most recent best-selling book, these have been flying off of our warehouse shelves, I have in here 14 chapters on the left brain side. The right brain side you flip over, and that has 62 actual stories, and that's 12 chapters. But in the left brain side, we have in one of the later chapters what can go wrong and how to prevent it. And on page 211 is where I'm at in the book, okay? And this is the book I'm going to gift you at the end of this episode. But it's called the Laser Ready Test. And if you're partnering with an IUL agent, it's critical that they're proficient. They know what they're doing. Knowing that, I put in here 14 questions that you can ask an IUL agent. And if they don't know the answers to these questions off the cuff, that's a red flag. If they say, oh, golly, I don't know, I'll have to find that out. Or if you can tell they're faking it, that's a red flag, and I would be careful, and I can point you to somebody who I already know is proficient, that has passed a proficiency exam. But to just give you an idea, the questions are, what's Tefra, DEFRA, and TAMRA? I mean, if they go, oh, I don't know, I've heard about those, I don't know. Oh, that's a red flag right off the top, okay? Explain to me Internal Revenue Code Section 72E, 7702, and 101A. Every IUL specialist should know those sections of the code. What's the guideline single premium? If they don't understand that term, that's a red flag. That's the amount, the total amount you can put into the policy during the life of the policy. What factors will the insurance company consider when gauging the size of my policy? If they don't know answers to questions like this, what size policy, how much death benefit would a 60-year-old need if they were going to put in $500,000 in a guideline single premium? Now, if they don't know pretty much off the top of their head that it's about double that $1 million, that's a red flag. That tells you they don't do this very much, okay? And how can an insurance company earning 4 or 5% on their general account portfolio afford to credit you 7, 8, 9, 10, 11% on an index? If they can't explain how indexing works, that's a red flag, okay? How can policy owners earn an extra 1 or 2% higher rate of return when they're turning on income in retirement? If they don't know how to explain something like a spread or an index loan, golly, if you're doing this for retirement, you may want to reconsider the advisor, okay? Over the life of an IUL policy, if it earned a gross return of 11%, retroactive back to day one, what should it have really netted me? And it should be within 1% if it's structured correctly. If you're credited 11, you should be netting 10. If you're credited 9, you should be netting 8. If they don't know that, or they can't figure out how to do that, that's a red flag. You might want to ask, how many insurance companies do you represent? Because if they're just a captive agent, they can only sell that company's products. Or how many max-funded insurance contracts have you sold? How about this one? How many of these do you own? See, I own several. But if they don't walk their talk, I would be careful. So you want to make sure that the professional is in it and they believe in it, they walk their talk. And so I invite you to claim your free copy of this book. And you can go to page 211 to 212 and read those. But here's how you can claim your free copy. Because if you go to Amazon, they're $20 and you'll pay another $10 or so for shipping and handling. If you do, thank you. But if you simply go to laserfund.com, laserfund.com, or click on the link below, and you contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game. I'll cover the rest of that, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. While you're in there claiming your book, if you also like to listen and learn or watch and learn, there's audio and video formats. Check out some of the educational webinars we teach on a regular basis. They're free. You can even schedule an appointment with an IUL professional who is proficient that I oversee. There's no cost, charge, obligation, and you can see how a properly structured IUL should be structured in your particular set of circumstances. So I hope you've enjoyed this, and I hope it helps making any mistakes when you're looking to have an IUL structured correctly.